Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And as the title of this series implies, this webcast series is all about selling income options. Now, interestingly, premiums are particularly strong right now, and that might be a good thing for some people, but is it just inherently good that premiums are high? Why are premiums so high compared to where they've been mostly over the last several months? We have a lot to talk about. We're going to be selling a put, comparing it to previous puts, and seeing why the premiums seem to be so juicy at the moment and what the trade-offs are for that. Before we can get to any of that discussion, though, let me first of all say hello to everybody who's chatting out there in YouTube. Great to see so many familiar names as always. Hello there, Ted and Hope, Kevin, Jay Richardson, Mark, Ricebird, Josh, Willie, Eva, 56, El Toro, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy that recording, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time each Monday. We'd love to have you here as a live stream audience member. And as a treat for our live stream audience member, my very good friend Barb Armstrong is hanging out in the chats. Barb's going to be addressing any questions that I can't get to during the flow of the presentation. Thanks for having my back there, Barb. And Barb and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters on X. It's the best place to connect with us when the cameras aren't on. You can find Barb on X at Barb Armstrong CS. You can find me there at Cameron May CS. But let's get into this discussion of why options premiums are so high right now and what that might imply before we go sell into an income strategy. All right. Now, as we do, of course, we need to pause to consider the risks associated with any trading or investing strategy. This is important information, so bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal. Schwab does not recommend the use of technical analysis as a sole means of investment research, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set the agenda for today's discussion. Now, as some of you certainly know, some may not know, this webcast or this video is part of an ongoing series. And I saw an opportunity for learning that goes back to a trade that actually just concluded. What I noted was we previously sold a short put. It's actually wrapped up profitably. That's nice to see. But I was considering selling a new put on the same stock today and noted that the premiums were considerably higher on a day-to-day basis. And I wanted to talk through the logic of why that happens and what traders might want to consider before they go pouncing on an apparently more attractive or juicier premium. All right. So we're going to take a look at our existing positions. Then we're going to take a look at current market conditions and then plan and place that new trade, comparing it to the last and discussing why income potentials are higher right now, but there's a risk side to that discussion. All right. So let's go right to it. We're going to be planning and placing that example trade with some exits. But before we can get to that, let's look at our current positions. So here we're on the Thinkorswim trading software platform. This is the desktop platform that we get downloaded free of charge from your Schwab Online account. And we have 5 current positions, and the one that we've recently concluded, I'll leave that one to last. Just so you know, it's a position on NVIDIA. But right now we have Amazon. We're in a covered call. Bought the shares at 221.52. They're down a little bit, but at the same time we sold a 235 call for $1.58, and that's only worth about 18 cents at the moment. Not much premium left there. We could probably buy out of that fairly inexpensively. So we'll probably wind up doing that. But let's go see what's going on with our chart of Amazon. So here we took our trade, bought the shares at 221.52, sold that call up here for $1.58. The stock actually started a rally, but just along with just about everybody else, we had that strong downside on Friday. A little bit of a recovery here, but this has positioned us actually just above our break-even point if we were to allow this contract, this contract to go all the way to expiration. However, I think what we'll do here is close this one up. So this doesn't expire for a few more days. There's a high probability that it will just expire. We just left it alone. But I think what we'll do with this, I wonder if we could roll this down, maybe extend it out. Looks like there's an earnings announcement out there. So that's on the 30th. Let's keep that in mind. Some traders, when they're selling covered calls, don't like to carry those contracts over earnings because it limits the upside if the earnings goes well, but we have a large exposure to the downside as shareholders of the stock. So let's leave that unlimited upside potential there as of the moment of earnings. So we'll look at the contracts that expire before October 30th, okay? But yeah, how much did it look like we could maybe buy this back for? About 18 cents, possibly. So let's go look to see what credit we can receive before October 30th. That's not going to be very far out, maybe about a week and a half. Let's look at maybe these 24th of October contracts. And could we go up as high as 230? Yeah. 230 would be up above these previous highs. So that would be right up here. Let's go to today's candle. And this is what I'm considering. Let's think about maybe selling that 230 call and take that out to, that was just going to be on the 24th. So it's going to be a pretty short-term covered call. So that's going to be out of that contract before the 30th. Let's maybe do that one. So we're going to go to our monitor tab. Going to right click on our 235 call that we're in right now, and we're going to create a rolling order to sell. Yeah, it'll describe it as a calendar, but it's really just in order to buy back the call that we're in, and we're going to sell out there on the 24th of October. Not the 235s, probably not going to get much for those. Let's go to maybe 230. And we might be able to get about $1.38 credit. Let's say that we're even willing to go down to the natural. Pretty narrow spreads on these. These are pretty liquid, heavily traded contracts. I might even say, just for the sake of getting hopefully a quick fill, let's say that we're willing to settle for even $1.35 credit as our minimum credit on the roll here. So let's click confirm and send. So if we're able to fill this order, we're going to be buying out of the current contract, selling into a new one for the 24th of October. That would generate a minimum credit of $1.35 minus the commissions to do these trades. When we roll, we have to know that rolling creates additional commissions, so that's a consideration there. But maybe increase our income potential on this trade. So let's send this off and see if we can get a fill. Yep, looks like we rolled it for $1.35 instead of $1.39. Josh says, Cam, for this position, are we okay with the stock being called away? So yeah, that's a good question, Josh. The trader, whenever we're selling covered calls, let me just say this. Covered calls are not appropriate for a trader who does not want their shares sold under any circumstances, because that's always a possibility. So my assumption always is, yes, the trader is okay with the shares being called away, because that's never entirely in their control when selling covered calls. So the answer there is yes. So if we did, though, what would that net do for this trade? Well, we've already now realized a gain on this call that we just exited. If we were assigned and the shares were called, it would allow us to keep the premium that we just collected. It looked like it was probably in the $1.55, $1.50 range. So that would be a realized gain. And we'd be selling the shares at a higher price than we paid for them. So would it be a profitable exit? Yes. Would it be an optimized exit? That depends on circumstances at the time. Eva says, amen, Cam, you've stopped doing covered calls for that reason? Yeah, because if the trader does not want, if the trader wants to retain control of whether the shares are sold or not, covered calls is not the strategy for them. Okay, so let's go to our trade here. So with Amazon, we just sold that call. Yeah, it looks like we got $1.57 for that. And it's trading right around there, so we'll see how that goes. But we've closed this one up. I'll update that later. But now we're in an obligation. We might have to sell our shares for $2.30 instead of $2.35. All right, so we're done with that trade. Let's look at Bank of America. And this one, we just own 200 shares. And this webcast series is not called buying stocks. It's actually trading covered calls and short puts. So why don't we have a covered call here? Well, because these contracts expired worthless. All right, what happened? Let's go have a look at our Bank of America on our chart. And if you're wondering where all this information comes from, I just drew this in. So it's not automatically populated here. You'll see me add these notes on the chart during the live stream. But in any case, we bought 200 shares for $50.58 in this position, sold the $51 calls. Look at this. Stock went actually up above 51, then sagged back down below, and we hit expiration below 51. So that's a realized gain on the calls. But these shares that we bought, they're kind of struggling. There's a decision to be made. If the trader doesn't feel strongly about share ownership now, even selling covered calls may not be an appropriate move. Maybe it's time to sell those shares. At the moment, though, it looks like we're sitting right at a support level. And there is an earnings announcement right around the corner. So what I'm going to do with this one is just leave it alone. We're not going to sell a call against it. We're just going to ride it through that earnings. If the earnings goes well, great. If it doesn't go so well, ouch. So we're going to see what happens there. But I'm going to leave that one alone. That takes us to our next Terra Energy. This one's pretty interesting. Bought the shares for 72.5 as a result of an assignment on a put. Shares are now worth 84. Awesome. Except we have the obligation to sell those shares for 75. So going back to Josh's question, this is one of the realities that a trader has to be prepared for when selling covered calls. We're not in control with where we sell those shares or if those shares are sold. Let's go have a look at our NEE. Here's what happened. So we sold a put back here. That was assigned. So we kept that premium. That's a realized gain. And we owned the shares at 72.5. Now, along the way, we've sold some other calls against that, collected more premium, made some more profits. That's nice. But most recently, and with our break even down here at 68.41, we sold the 17th of October $75 calls. Those expire in just 4 days. And look what the stock did. It went racing up, but we're obligated to sell it all the way down here. So if we do sell it, well, we bought it for 72.5, sold for 75. It's $2.50 realized gain if that happens. What that would be added to $1.01 collected for this call, 55 cents here, 97 cents there, $1.56 there. Overall, not a bad trade. Is it the optimal outcome for this trade? In this case, not really. So Josh is saying, could we roll this up and out? Could. Yep. Rolling up means let's buy out of this call, which is going to be pricey. It's going to cost us a lot to get out of this call right now. But that might allow the trader to sell another call maybe above the current price. So maybe assignment risk isn't there anymore. The difficulty there is then we have a big realized loss on that call instead of a little gain. And if the stock pulls back, now we're surrendering gains on the stock as well. With this one, I'm actually just going to let it get called out. There's a possibility it doesn't get called out. In the next 4 days, could we drop back down below 75? Yes. Is that likely? No. The most likely outcome at this point is, all right, we sell our shares for a small profit. We have 4 profits on our calls that we sold. That's a profitable outcome. I'm going to leave that one alone. Okay, now we have our Visa, another covered call. Bought the shares for $330. They're worth $344, which is actually a little below the $355 call obligation. That one, we sold it for $305. It's worth about 61 cents. Still some income potential left there. It's unrealized gains at this point. But here's what it looks like on our chart. Okay, we started this one off. Selling puts, we got assigned at $330. And then we've collected a profit here. That's in addition to the profit made on this premium, profit made on this premium. We've sold a call, $355 call for $305. You can see we're a good distance below that right now. So it's in good position to just expire worthless. We're still above what we paid for the shares. I'm going to let this one go for a few more days. See if we can get the last 61 cents of juice out of that trade. Now, obviously, if the stock skyrockets, we may get called at 355. If the stock plummets, we still own those shares. In any case, we'll just be shareholders as we hit that. Not in any case. If we get called out, we're not shareholders. But if we're out of the money, if the contract just expires worthless, we'll just let those shares ride through that earnings. Because as a shareholder, earnings are just sort of a fact of life, right? So that's the next one that's coming up. And finally, not finally, our final current position is our Walmart trade. Another covered call. Bought the shares for 95. They're worth 102. Sold a 105 call for $1.42. It's worth 23. So that's doing well as well. So we look at that Walmart position. We are assigned on a put back here, realized gain on that premium, realized a profit on this call, sold a call here. That one's doing well. 4 days till expiration. Our break even is way down there at 91.12. I'm going to let this one go to expiration as well. Still taking a risk. If we get a pop in price, we might wind up selling our shares, but that would be well above what we paid for them. So that's it for our current positions. Let's talk about the trade that concluded recently, and that was NVIDIA. Now, that last week, I was out of the office, so we didn't have, well, I wasn't here. Brent took over for me, always does a fabulous job. But let's see what happened with NVIDIA. So if we go and look back over the last 30 days or so, let's look at our trade history. We had an NVIDIA put, and we sold that put for $385, and we had a limit order in to buy it back if we could buy it back for not more than 20% of what we received for it. That was 75 cents is where we put our limit. We actually filled at 57 cents, so that's a realized gain now. September 22nd to October 9th. That's not the entire history with NVIDIA. If we look at the chart of NVIDIA, we sold a put here that expired for a 258 profit. We sold this put most recently, sold it right there on September 22nd. We were planning to take it all the way to October 17th if necessary, but instead we were able to buy out for just 57 cents. So that's a realized gain. Did I do my math correctly there? What did we? I want to make sure I get that right. 385 minus 57. Let's crack open our calculator. 385 collected minus 57 spent to close out is a 328 profit. I knew that didn't look right. There we go. There we go. All right. Anyway, made a profit there. So done with that trade. But what I wanted to talk about today was we're probably going to wind up selling another put here, just like these first two. But what caught my eye was the premiums that were available. Premiums much higher than historically available, at least recent history. So first of all, why would we possibly be selling a put right now? We've had some interesting activity on the major market indices, of course. Friday was a rough day. We've recovered, as of this moment, the bulk of the sell-off from Friday. I'd say we're maybe 60% of the way, 65, let's call it about 60%, just eyeballing it, coming off of those Friday lows. So a nice little bounce. So maybe let's say that our hypothetical income investor has just noticed that there's a bit of maybe a tipping point off of these highs as we carry those through previous highs and lows. Old price resistance looks like it's acting as a new price support or price floor. Friday's sell-off took us right down to that floor, and it looks like we might be bouncing. So let's say that our trader here, our income trader, still thinks things are bullish. Could they change? Of course they could change. But we're going to be placing another bullish trade, and selling puts is a bullish income strategy. So hold on a second. What's this? I just noticed a chat there. I want to make sure somebody's not. That looks good. Anyway, Barb's doing a great job. Thank you, Barb. Anyway, let's just say that we're bullish. We're looking for income. And so our trader is going to go sell a put. Could do a covered call. We actually have a bunch of covered calls in place. So I thought it might be a little bit redundant. Let's get some variety. Let's sell another put today. So going back to familiar territory, we're going to be looking at selling a put on NVIDIA again. But premiums on NVIDIA, as I mentioned, are much higher than they were the last go around or two with the puts that we've sold. As a matter of fact, I can structure a trade that's nearly identical to the previous NVIDIA put, and yet the premiums are way better. What's going on? Why are premiums so high compared to where they were just a few days ago? Why are they at or near their highest levels in the last several months? That has to do with all of this volatility that came with Friday's activity. Volatility tends to spike premiums on options. But what happens, here's a chart I wanted to discuss today. Let's go look at the VIX, the volatility index of the S&P 500. And we're not seeing premiums like we saw back in April. But if we zoom in on the last 6 months, we will see a prominent spike on what's known as the volatility index. So for some options traders, including income sellers, they'll use this index as a general gauge for the sorts of premiums they might expect to pay if they're buying or receive if they are selling, because there's a strong correlation between volatility and options pricing. And the logic for that is that options buyers see a ton of potential in highly volatile market conditions or on highly volatile stocks. Why is that? Well, the story that I like to tell is that if we have, let's say that we have two stocks the trader is considering buying, let's say, a call option on. Okay, they have stock A, which is at $50. Last month it was at $50. A year ago it was at $50, and they're thinking, well, if I buy a call that gives me the right to buy the shares for $50 for, let's say, the next 30 days, how exciting does that sound? We have this stock that's just been not doing anything at all, completely stable. Obviously, that's an exaggeration, but it makes the point. That kind of pure stability might lull a would-be option buyer to sleep. Owning the right to buy a stock at a fixed price when prices haven't changed in a long time, not terribly attractive. On the other hand, let's compare that to stock B. Right now it's at $50, but last week it was at 40. The week before that, it was at 70. The week before that, it was at 20. Stock is just all over the place. And now that trader might say, boy, if I buy a contract for a month that locks in a purchase price of $50, if that stock just gets a tailwind, it could go $10, $20, $30 up. There's a ton of potential in that. And they might be willing to pay a higher premium for the right on that second stock than on the first stock. There's a higher demand from speculators, but also from hedgers. Yeah. When stocks individually or as a group, as measured by let's say an index, if they're bouncing all over the place, hedgers may use options to try to reduce that volatility. In any case, that can drive up the demand for options from those hedgers. At the same time, demand is increased from speculators. Yeah, so volatility, an increase in volatility is typically strongly correlated with higher prices or higher premiums for options. So for our would-be option seller, let's look at current conditions. That volatility that we saw on Friday has driven options premiums to levels that we really haven't seen except for a few sparse days over the last several months. Hey, so income potential, if we're selling premiums, is greater right now. Now, does greater income potential equal better income potential? That's a good question. Not inherently. High volatility means high volatility. Trader has to be willing to accept that we're stepping into choppier waters. There's greater risk during higher volatility conditions. That's why there's greater reward potential. So let's go see how that connects to an NVIDIA put. So I'm going to go back to our NVIDIA stock. And yeah, we got some volatility on Friday, but interestingly, that brought us right down to previous highs. Looked like there was a price ceiling for a couple of months on NVIDIA. and we pushed up and through that. It acted at a pretty good floor right there. Looks like we might be looking at breaking that on Friday, but we've closed back above that today. And for a technically oriented income trader, maybe they think that's projecting possible move to the upside from here. Now, let's sell a put. I'm actually going to make it, I want to mirror our last trade. So this 17th of October put that we sold, we entered that on the 22nd of September. So if we do the math on that, if we sold that put on the 22nd of September, that was 25 days before the 17th of October. I want to put on a 25-day contract that's as similar in construction to this previous one as possible. So we collected, now remember, we didn't collect a 328 premium here. The original premium was actually 385. We had to pay 57 cents to close it out. So for a 25-day contract, back in the third week of September, we were able to collect a $3.85 premium. Let's go to our trade tab. And I want to look at a 25-day contract. There just happens to be one. The 7th of November weekly contracts happen to be 25 days from expiration. And with the stock trading, look at this. It's at 188. That's interesting because I went back and looked at the video from the last put that we sold, and it was $8 out of the money. $8 out of the money. What would be an $8 out of the money contract right now? That would be the 180 put. This is getting more and more interesting because last time when we sold an $8 out of the money 25-day contract, we collected $3.85. How much could a trader possibly collect right now? It's more like $4.95. That is way higher premium. Let's say that we get $4.95. That'd be $1.10 higher than the last premium. If I take $1.10 and divide that by the last premium we collected of $3.85, that means we're getting 29% more premium right now than we did on our last trade. It's the same stock. It's the same distance out of the money. It's the same time till expiration. This is very much the same trade. Mark says, are we chasing short premiums here, short-term premiums? I didn't say anything about chasing. Chasing implies desperation there, Mark. And I think that's a good way that you phrased that. No, these are hopefully I've set sort of a logical premise for this other than, it's not revenge trading. It's not trying to make something out of something that wasn't working. Actually, this has been doing just fine. And we didn't just go blindly place this trade again, instead setting some technical logic. Obviously, even technical analysis doesn't guarantee that our stock is going to continue higher. But yeah, it's not a trader who's sort of blindly, willy-nilly selling puts. We made a conscious decision to sell a put on NVIDIA, but also to make this point that I wanted to make today was that premiums are just way higher than they were just recently. But I did want to talk about the logic of why they're higher. So if we were to sell this put, so we're looking at selling maybe the 180. So there's where the stock is today. If it goes up, great, because we're going to sell the 180 put, which is down here, and we're going to have that expire. I mean, what was that going to be? Was that the 7th? Yeah. Well, what date did I pick? I got to double check. Yeah, the 7th of November, 25 days from expiration. So let me right click on this line that I've just drawn. We're looking at selling the 180 strike. You can just edit the properties of a line. You can have that go out to, let's take that out to expiration. There we are. So there's our put that we're considering. And if it's also helpful, I can draw in a vertical line here to represent that expiration, because it's not one of the third Fridays that just shows up when we choose to display the expirations. So there's our trade. Now, why are those premiums so strong right now? Well, because along with the rest of the market, NVIDIA has become choppier. It's become, in some ways, less predictable. Now, things could settle down. If it gets quieter, that would actually be good for this trade after we've placed it. If the volatility quiets down, what would that do to the price of options if we're looking to close them out? Well, if volatility spikes cause premiums to go up, quieter volatility is likely to bring those premiums back down and maybe let sellers exit at lower prices. So that's what the trader might be hoping for here. But I just want to make sure that we're not literally, I'll use your word there, Mark, chasing premiums. We're going into these instead with our eyes wide open. Yes, they are stronger premiums, but also we know that's coming from just greater volatility. That means that this thing could fail faster because volatility can work in either direction. Mark says lower volatility means premiums are less juicy. Exactly right. Less juicy, but possibly also lower risk. There's a reason for the flow of juice when it comes to options. All right. But we're going to go ahead and place this order. Let's sell that 180 put. That's going to be below our apparent price support level. If we break down, there's even some wiggle room there. As long as we don't go down below 180, we'd still be out of the money. Now, even out of the money options can be assigned. But what we're getting into here is a contract where someone has the right to sell shares to us for 180. If the shares are worth more than that, they have little incentive to actually enforce that right. If the price of Nvidia falls below 180, now we might wind up owning shares. So going back to an earlier question where I believe who was it that asked about getting called out? Are we okay with getting called out? It's a good question. Anyway, when selling covered calls, the trader better be okay with getting called out. When selling short puts, they better be okay with buying shares because that's the contractual obligation associated with this sort of income trading. All right. So let's see. Duke says, so that's why if it's close, you're better off closing your position unless you want the shares. Yeah, if we get closer to in the money, that elevates the risk of early assignment. If we go in the money, it elevates the risk of early assignment even more. As we get toward expiration, a combination of factors can really elevate that risk of early assignment. Going deep in the money and getting close to expiration can raise that assignment risk. But really, assignment can happen at any time. We might feel like we know what's going to happen. We might feel like we're in control. We're not in control there. Assignment can happen at any time. But going back to our trade, let's go ahead and sell this put. Get those, yes, juicier premiums, but with our eyes wide open for why we're receiving those. That's going to be right here. We're going to do that 180 strike. That's $8 out of the money, just like our last trade. Let's click on that. For this trade, let's just do one contract, obligating ourselves to potentially have to buy 100 shares at $180. Now, the objective when selling puts, for some traders, they actually are totally fine. It may even be their preference to get assigned. Let's say that our trader here is aware that they might have to buy the shares, but their preference is actually to just collect that premium and hopefully close it out before assignment. So let's have two plans in place to manage risk and also manage reward in this trade. So it looks like we might be able to collect about 485. Let's talk about managing the reward. That's the fun part of this trade. If we're able to collect 485, let's say that our trader would be happy if, let's say they were able to exit the trade for not more than, say, 20% of what was collected. So let's come over here. Let's go to our calculator, take 485, and I'm going to multiply that by 20%, 0.2. So that means we can pay about 97 cents. If we were to collect 485, looks like it might be 490. Let's set it at 485 for right now. Okay. We'll kind of put that in as our limit. We might be able to get more than that, but let's say that we're able to get 485. If we collected 485 and then we spent 97 cents to get back out of that trade, that would leave us with almost $4 of realized gain. So that'll be our plan. Let's try to get out for 97 cents or less in sort of a best case scenario. Well, what if the trade is not working? What if instead of the value of this put going down and allowing an opportunity for profitable exits, What if the put is going up in value? Not so good. How about in this case, let's say we're willing to risk, let's call it 50% of the 485. That would be exiting. Let's take 485 and multiply that by 1.5. That would be the value of the puts are going up instead of down. In other words, the stock is probably falling. Maybe the trader wants to be out of this trade. Now, this is going to be, that would be fairly tight, just to be completely realistic here. That could be only a few dollars move to the downside. Now, the trader could alternately just say, let's buy out if the price of this. I haven't done that before. Can we do that? Maybe I'll do that in this webcast. Little executive decision here. Let's put in our target to get out for 97 cents, and our stop, we're actually going to put it in based on the value of the stock. Okay, so how might we do that? Down here, let's go to our advanced order. Let's change this to, instead of just placing one order, let's put in 3 orders. 1 to get in, 2 to get out. That would be our first triggers OCO order type. I'm going to right click on the original order and create an opposite order. I'm going to right click on that original order and again create an opposite order. So one of these is to buy us out profitably if we can. I'm going to make that good till canceled, and that one is going to be buying out if we can do it for 97 cents or less. Now, on the other hand, let's put in a conditional exit order. Let's say that we want to buy out of this put at whatever cost it requires if it's going to let me do this. I haven't experimented with this exit in a while, but let's put in an order to get out if NVIDIA, the market value, falls below, less than or equal to our strike price of $180. Okay, click save. And let's click confirm and send. Now, if you didn't catch the logic there, here's what we're doing. We're putting in an order to do this, buy that put for a future market value. What is that future value? We don't know. All we know is that it's the cost to buy out of a put. At the moment, our NVIDIA shares have fallen below 180 if they ever do. That's it. Would it be a higher cost than it would cost like right now? Yeah, we'd be taking a loss there. All right, let's click save again. Let's click confirm and send. And we're going to sell this put. We're going to sell that for $485. We're going to try to get out of it for 97 cents. Or we'll get out of it at whatever put costs at the moment NVIDIA falls below 180. Now, some things that we need to keep in mind about these. First of all, there's a reminder here. Please note that you've selected a weekly option series with a non-standard expiration date. That's right. 7th of November is not the third Friday or the traditional expiration. And due to potentially wide markets or liquidity risks at the time of activation of the stop order, that order may be manually substituted because it would be a market order. It may be manually substituted with a limit order upon activation and worked until filled. All right, now there are commissions to be paid to get into or out of these trades if we come to that. I'm going to send that order off. And let's see if we can get this thing filled. So as we go to our activity and positions page, let's look at our working orders. We're trying to get 485, trading at 490. Yeah, I figured we're going to get more than that. We got $5 for this. So there we go, guys. We actually did. Now, let's revisit this. We just got $5 for a contract that's basically the same distance out of the money, that's exactly the same distance from expiration as we collected back on September 22nd. It's because of the volatility of the markets. Volatility can increase income potential, but it also carries enhanced risk. So there are pros and cons to selling premiums when they're apparently more juicy. All right, everybody, we've accomplished what I wanted to do today. We looked at our existing positions, took a peek at the markets, talked through why juicier premiums become available at times and the pros and the cons of those. So these sorts of discussions are what we have on Mondays. I hope that you'll put it in your calendar to join me each week or just to watch the recordings. That's fabulous as well. Barb, thanks for helping out in chats, but everybody, I'm going to let you go enjoy the rest of our educational offerings for the rest of the day. But I want you to be aware of all of the educational resources you have from Schwab. Number one is to make sure that you have subscribed to our Trader Talks channel. If you're new to Schwab or if you're new to watching these videos, make sure you subscribe. You can go down and click on the subscribe button right now. It only takes a second. It's literally like click, done. But it doesn't cost anything to do that. But our Trader Talks Schwab Coaching webcast channel is where we house these webcasts on an ongoing basis. You can join the live streams right here, or you can find the previous ones right there organized by playlist. So for example, if I click on playlists and I scroll down toward the bottom, I'm looking for this webcast series. So it's trading covered calls and short puts. So if I go down a little bit further, you'll see right there, trading covered calls and short puts. There's Brent because he covered for me last week. And if I click on view full playlist, I can see all of the webcasts in this series right there. Now, another thing I would strongly suggest you do is to follow your favorite Schwab presenters on X. If you have an account with X, you should be following your favorite presenters there because it's the best place to connect with us in between these live streams. You can find Barb on X at Barb Armstrong CS. You can find me there at Cameron May CS. But this is where we can have discussions about the markets. And we can also, you can get updates on my weekend or whatever. But like, for example, just about an hour ago, I reposted this really interesting chart that Rachel had posted. Silver has apparently been making a pretty good cup and handle. That's fairly textbook price pattern. So I wanted to know, among my followers who are chartists, what do you think? Is silver going to break out of that cup and handle and hit some shiny new heights, or do you expect the price to tarnish? A little bit of, all right, silver puns being dropped there. But if you reply to one of my posts, I try to reply right back to you, and it allows for learning and interaction outside of these live streams when the camera's not on. All right, another thing that I would show my appreciation for is a lot of you have already clicked the thumbs up on YouTube. 146 people watching a live stream right now, and there are 40 that have already clicked that like button. That is very much appreciated because yes, it's a pat on the back to your presenter for a job well done, but it also has a direct impact on how much visibility this video gets on YouTube. It gives us a promotion through the YouTube algorithm, so more people can find the video. The more people like it, the more YouTube says, hey, people like this, and they promote it to other people. Yeah, people can learn about things like why options premiums become more or less juicy at different times. So thanks for doing that. Everybody, I will see you in a future webcast. Barb, thanks for helping out on the chat. And guys, whenever I see you again, I'll look for you on X. I'll look for you in a future webcast. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.